You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Tim Cyclesman Wood, editor of Cycles News and Views on Cyclesman.com. Happy New Year, Tim.
Jim, Happy New Year.
Well, the very last show that we did, talking about what was going to happen in 2016, did happen. Just as predicted, you said, this thing is going to blow up. The markets are going to be a mess. Why haven't people listened to us? And you said, well, you know, the cycles had been so bent out of shape that finally people were feeling the abnormal had become normal because it continued to go up and up and up. And you were just saying, please, folks, pay attention. If they would have listened to your last interview, they might have saved something if they hadn't already bailed out of the major markets. So what should people be doing now? And what about the psychology of this whole thing? It can't come down. It can't be true.
Well, you know, I said that I don't remember everything we said, but I do know that I said that going into 2016, the risk was extremely high. I mean, we exited December with the risk extremely high. And with the setup and the structure of the market, it did pretty much what it was supposed to do based on that setup as we exited December and into January. And the thing that I find interesting was when you look at the fear factor, which is measured by the VIX, and, you know, I don't know how exactly the VIX is calculated, but I do know that it's basically, in short, it's a measure of fear. And the fascinating thing here is, to me, is that nobody gets it. You know, you look at, you'll move, we moved down in December and we had a reading on the VIX of whatever it was. I'm not looking at the chart, but we had a little bit higher reading on the VIX, and then we turned up and then we moved back down, but the VIX made a lower high. And then the market, as the market has stair-stepped down, so has the VIX. It's like people don't understand what is going on, and really that's all the more perfect for the bearish setup. And it's just amazing to me that we have a Dow theory primary bearish trend change in place, and the setup that we have, and there's just absolutely no fear. People don't get it. And, you know, this little decline that we've seen in the last couple of weeks, this isn't even the opening shot, man. I mean, come on, there is so much more to come. And I'm saying this right as we're moving into what I think is a short-term, possibly even an intermediate degree bottom. Could evolve here. Depends on a couple of factors, but you know, we're moving into the time frame for an intermediate degree low as well as a short-term low. And what I'm saying is I need to see exactly how that develops to determine if we have it. So I'm saying it before I have any sort of confirmation. But the point is this. There's going to be bounces along the way. And if we bounce from here or even a little lower, you know, that fear is just going to melt away and people are going to think everything's okay and now we've had our correction and so forth. But, you know, I don't want to say, well, how do I say this? It's the ultimate mind game. The bear I wrote back in July when we had the initial setup with the initial leg down, I said that there would be false rallies, false hopes, and I talked about how dangerous this market was because of the duration of it and how the abnormal had all of a sudden, because it had been so abnormal so long, it seemed normal. And this is a point. This is a perfect, what we're seeing here with the absence of fear makes that point perfectly clear. There's no fear. And I just think that makes it all the more dangerous because, people don't see what's coming, obviously.
Well, I guess it's like penguins. They have no fear of humans, but they should.
I guess. But anyway, just looking at the psychological aspect of this is quite fascinating. And, you know, you mentioned that people think, well, that can't happen and, you know, this time is different and that sort of thing. And, you know, again, that's just, you know, based on what? People will say, well, I don't think that can happen. or I don't believe that, or whatever the case may be, and based on what? And I hear this. I was talking to someone at the gym today, or yesterday, I should say, about the market and what I potentially see here based on these statistics. And I mean, my work is based on, I mean, I did accurately call the 2000 top and the degree of the decline, missed the bottom by 200 points on the downside in 2002, did get the 2000 top right, so on and so forth. I'm sitting here talking to this guy and telling him what the potential is here, what the statistics say, and the response was, "Oh, I don't believe that can't happen. They're not going to let that happen."
Who's they, and how could they stop it from happening?
Exactly. And where were they whenever we had the 2000 top and that meltdown, and then where were they when they created the worst financial crisis, like I said, since the Great Depression into the decline in 2009? And it's just, like I said, that's what makes this so dangerous, Jim. And I've made this comment before that, you know, when the rally out of the '09 low began, I knew it was a 4-year cycle low, had no clue that it would be stretched to the point that it has been, didn't think it would make a new high, but I did say that the longer it went, the more dangerous it would become, and that has absolutely happened, and this is why. This is what I foresaw. I knew that the longer it went, the more people would discount the possibility that we were still, or I should say, not only the possibility, but I mean, from the work that I do, the fact that we're still operating in a secular bear market and have been, that just, you know, they can't comprehend that because it's been up too long and it's made a new high. And so how can any of that be? And the abnormal has become the normal in linear thinking and all that sort of thing. And so people just, they're clueless. They're clueless about where we're going here.
Also, when a market starts to have a dramatic fall, it will fall 3 to 4 times faster than it climbed, right?
Absolutely. Look at any decline. Any decline. The 2000, think about this, it took it from 2002 to 2007 to make that advance, and it took it, I think, 17 months to erase all of that and then some. And you look at, any major decline is the same way.
What about the Chinese government thinking that they can change this if they just throw some money at it?
Well, that's what got us in this position in the first place. That's the kind of thinking, like I said, that caused the problems with the bubbles into the 2007 top, and the consequences of the air coming out of that bubble as we saw into 2009. And then they've done more of the same here. And it's time that they stop. And I think that the Fed probably has, at least for now. But these governments, they need to stop because they're only making matters worse. I mean, you eventually have to take the medicine. And it's time that we, as a people, as a country, as a world, I mean, all of these global stock markets have to take the medicine. And what I mean is the consequences of all the reinflation, the consequences of all the extended cycles have to be recognized.
Well, they should stop supporting overpriced stocks, right?
I agree. And let a free market be a free market.
Well, we know the Fed always says, well, don't worry, we'll look after you. But since the Fed was invented, haven't we had something like 28 recessions?
I'm not sure how many recessions,
some number like that,
and what they're calling a recession, but since the advent of the Fed, we've definitely had the 4-year cycle. We've definitely had secular and bullish and bearish periods, and you can't, that's the thing. You cannot prevent these cycles from occurring. I mean, a business cycle is just basics. I mean, I remember learning about that in school, in elementary school, or not elementary school, but in like free enterprise or whatever. I mean, I remember from way back as a kid hearing about the business cycle and being exposed to that, and it's just a common observation. It's not voodoo, and to think, yes, you can obviously influence it, and you can obviously extend it, and you can obviously do things to make a cycle conducive to growth, but you can't extend that forever. Nothing is forever.
Why does the Fed continue to have the illusion itself that it's in control?
I think that one of their biggest tools is the jawboning, the illusion that they are in ultimate control. And to some degree that is true. I mean, they do have a tremendous amount of control, but they have their limits as well. And I think the reason that they have done the things that they have done is because they realized the consequences if they didn't. And I think it was a gamble in that, if they didn't do the things that they did, then they knew what the consequences were. But if they did do the things that they did, then I think there was a chance that they could rekindle things. They thought that they could, extend that secular period. And hey, if you could extend it, then why not put it off as long as you can? But the downside has been they've only made matters worse. And I think they realize that now.
Of course, the people calling the shots have multi-million-dollar or million-dollar salaries. They don't pay taxes. They don't live in the real world in the first place. How do we expect them to make decisions that affect the real world?
Well, I don't know. I don't mean to throw stones, but, it's kind of like the old, sometimes the old traditional methods of doing things, and one thing comes to mind is like the old ancient, the martial arts and Chinese medicines and even in more modern times, like I know an old hot rodder, an old guy, and I mean, he's old school, and you can get caught up in the technology of things and that sort of thing, and then this guy comes out and he says blah blah blah, and it's just real basic. And so what I'm saying is that we get caught up, I think, in thinking that because we live in a different era and because we're maybe allegedly more educated and because of whatever reasons that we know more than people knew back then, and maybe the methods, the old tried and true traditional methods, are no longer applicable in this new high-tech age. But that's not true. It's not true. And what I'm saying is these people that maybe are at the helm guiding this thing, they're probably oblivious to I don't know what they know. I really don't. But I have to wonder if they're not oblivious to, simple things like cycles and Dow theory and the market behavior with volume characteristics and secular bull and bear periods. And, you have to wonder. I mean, it certainly appears that they're just unaware.
Maybe they suffer from what I call Microsoft disease, where you have a perfectly good program. It does everything that you like. They come out with a new version that all of a sudden breaks that old saying, if it ain't broke, don't fix it. Well, when things are going well, they still feel they have to get in there somehow and change things and say it's new and improved. But in reality, no, it's not. What was there worked fine. And so every time they go and try to manipulate and change something that doesn't need to be changed, it goes, in the long run, affects you. All of a sudden, that program doesn't work the way it was. It interferes with other things. The old program was fine. And I think a lot of times these people who, quote, are in charge feel that they have to make changes or fiddle with things, or they're not doing their jobs, where sometimes maybe their job is just to watch.
Exactly. And, sometimes less is more. And that's a true story too. So, I don't know what's going on. I mean, obviously in someone else's mind or what they're thinking, but I do think that they obviously understand the consequences of and the risk to the downside, or they would have never done the things that they have done, in the last 15 years. So obviously they get that. Obviously deflation, there are deflationary forces that they have been trying to reinflate, and they have, like I said, they've done a masterful job. I mean, really have. But here we are again at like I said, I say again, we're at, the most extended 4-year cycle top in history, and it's all a result of the same things that caused, or the same measures that caused, I hate to keep using the word, but the worst financial crisis since the Great Depression, with the extension of the previous 4-year cycle top into the 2007 high. So, we're at a critical juncture, and it's deflating, and there's more to come.
Tim, oil.
Oil, we've been calling for oil to go lower, and I said I thought that it would eventually work its way into the 20s. We did see intraday 29 and some change hit. We should be getting near some sort of a short-term low. Ideally, there should be a little more, any bounce should fail again, and there should be another push down, and then based on the cycle count, unless this time, I don't want to say it's different because it's not different, but unless the cycle is running a little short, cycles they can contract, they can expand, but we're getting semi in the ballpark for an intermediate degree low is what I'm saying, and if it were to run a little short, then it could come sooner rather than later. But what we should expect, or what I expect ideally, is some sort of an intermediate degree low, probably in March or so. And then from there, we have a pretty decent bounce in oil. But I think it'll be just that, a bounce. I think it'll bounce into the summer, and then, we have to take it from there, but then I think ultimately lower. Between now and March, I think we're fishing for a low. I don't think it's in yet. I think there's lower prices.
Gold. Everybody thought if markets are going down, gold would spike sharply. It hasn't. There have been some days where it's gone up, but then it's usually erased in a day or two. Will gold take off?
Eventually, but we're still working toward, we had an intermediate degree low. I think it was on December the 3rd, I think was the date, that a short and intermediate term low was made, and people got real excited with this advance. But again, it should be a failure. I've said that it should be a failure that is followed by lower prices. We still have a 9-year cycle low that I think is still ahead. Now, I do look for that low probably in 16. It looks like it's setting up, but I don't think we're there yet.
Tim, I hope people pay attention to your interviews. We've been telling them about how things have set up. You said when the DNA markers are in, I'll tell you about it. You did. And you said the reason isn't that you're proud or of your work or anything. You just want to save the average guy from losing his savings again like they did in 2008.
Yeah, and I feel like I've rambled a little bit in this interview. Maybe I have, maybe I haven't. I just don't know what to say, other than that I'm just amazed how people they don't know what they don't know. And that's dangerous. When you don't know what you don't know is dangerous. When you don't know, then at least there's an awareness, and you haven't, you're in a better position to be aware and try to figure things out. But people are so arrogantly ignorant when it comes to the market, and I don't mean that in a mean-spirited way. I mean, I'm trying to reach out to them and make them understand, but they just won't listen. And, it's going to be, it's going to be a sad state of affairs when this thing, really gets going, and for the people that didn't listen. And all I can say is I have a track record. It's based on statistics, and the research is there. And I just encourage people, get to research and then make your decision.
Tim, thanks a lot for chatting with us. And I was going to say, when things appear on the evening news, it's usually too late.
That's true. That's true. And an example of that, let me tell you an example of that real quick before we go. I had a guy send me an email yesterday about the Baltic Dry Index, and they were talking about how it's collapsed and everything, and the implications of that for the economy and, the stock market and just the economy in general. And that's something that I watch and had written about and talked about, and I send you the letter. You can go back and look at this and verify it on occasion. I do report on the Baltic Dry Index, and I talked about how it had set up with another failed and left translated longer term cycle top, and how it was in trouble, and then it evolved within short order, within a month or so of that, and it did collapse. You know, we talked about how oil prices would go into the 30s and probably into the 20s a year and a half ago. We've talked about how the stock market is going to take the major hit that it's going to take, and statistically it should go below, or the statistics suggest that it should go below the 2009 low. And so as far-fetched as all this stuff sounds, it's just statistics and numbers, and it works. The track record is very, very good. And you're right. You know, when we hear about this with the stock market in a year or whenever, and it's sitting at 6,000, that reality is not going to sound so crazy, because you're living in that reality. And OTM's not going to be so crazy, but people are going to be devastated by it because they don't think it can do that. And I'm just urging people, get the research.
And of course, the research is available on Cycles News and Views on cyclesman.com.
Yes, it is. And the cost is minimal based on the exposure. I mean, my God, it's like Gordon Gekko said, and I paraphrase here, but remember the scene when he's talking to Bud Fox in the locker room, and he says something, I think that was the scene, he said, the most important, how did he say it? The most important commodity, or most valuable commodity, is information. Information. I agree with that. If you're informed, then you can make the right decision.
And if you want to be an ostrich and put your head in the sand, you deserve what happens to a bird that sticks its head in the sand.
Pretty much.
Yeah. Thanks again, Tim.
Thank you.
My guest has been Tim Cyclesman Wood, editor of Cycles News and Views on cyclesman.com. You're listening to HowStreet.com Radio. Our YouTube channel is Talk Digital Network. Find us on Twitter at Talk Digital Net. Comments about the show can be sent to info@HowStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com Radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com Radio is a production of HowStreet Media Incorporated.